Wealthies, welcome back. If you're new here, this is All the Wealth, our Wealth More Wealth Building channel, where we bring you guys the tips, insights to help you do better with your money. And today with me is Colin Horsford, and we are talking about taxes, the dreaded taxes for me. But we brought Colin on, who is the founder and CEO of Muse Tax, because he is shaking things up, and we wanted you guys to hear it on All the Wealth first and get a little closer to how you can optimize those taxes and not be like me who just like dreads taxes. Colin, welcome. Let's get started.
Thank you. Thank you so much for the opportunity to share a lot about what I've learned and talk a little about Muse with you.
Colin, it's such a treat to have you here today because this is a topic I think most people have like cuckoo anxiety about. And I think it's intentional that we're doing this kind of like after taxes because I think it would have been too much if we did it like the few weeks before taxes. But before we jump in, tell our wealthies a little about yourself.
Sure. So I've been doing tax and accounting for over 20 years. I started when I was 15 years old. I started in high school in the Academy of Finance, learned balance sheets and income statements the old way, literally pen and paper before, QuickBooks and all that stuff became really popular. My first job was in the tax department at 15 years old at not Credit Suisse, at CIBC World Markets. And then I majored in accounting in high school, which we were allowed to do because we were in the Academy of Finance. Went to Baruch in New York for accounting. Went through their accounting program, have a BS in accounting, and then started off at Ernst& Young in accounting tax specifically. And I was doing hedge funds and private equity tax and accounting. And that's also where I met my co-founder. His name is Mical Ogontania. He literally sat next to me. We worked on the same team together. We were able to get to CPAs within a year of starting working. So we were CPAs by the age of we went onto the banking sector. I worked at Goldman Sachs for a while. He went on to KKR and JP Morgan. Around the same time, we started our own CPA practices separate to one another. So he had his CPA practice and he said, why don't you just start doing some taxes on the side? I was like, all right, I'll do it, for some additional income. And then next thing you know, I started my own CPA practice, and that sort of led us to what became Muse because we were just having a chance conversation.
Colin, I mean, you started doing taxes at 15. Like, tell me there's some tax accountants in the family as well.
Nope.
No.
On my mom's side, they're all nurses and doctors. My dad's side, they're all blue collar and own businesses and it's not business, own property.
Wow. So you just took a liking to it. It's like it's almost like taxes is like your calling. Like you just love taxes.
I like numbers and I like discrete numbers, meaning there's an answer. So it's either right or wrong. Didn't mention this, but I also have a degree in statistics. I went to NYU. So I just
Okay.
like numbers and taxes. If you have to pay 30% times your total is your number. Well, it's technically not that simple, but yeah. I like the discrete nature of taxes. And it's also one of those things when I started out, there's a lot of job security in that. And my mom was very, she impressed upon me do something that had a lot of job security. And also someone told me, do things that people hate. A lot of times you hear people say, do things you love. I'm like, yeah, there's money in that, but it's also doing things that people hate, right? People hate hailing a cab, so they did Uber.
Yeah, Uber.
Yep, people hate
Yeah.
to get food, so there's DoorDash and Uber Eats and all
And
those.
Uber Eats.
Yep,
I've never heard anyone put it that way, but you're spot on. Like people hate doing their taxes. They will pay anybody any amount of money so that they don't have to do it. And then the consequences of not getting it right are so high that you definitely don't want to like risk it. Yeah.
exactly. Even if you can do it, how are you sure you're doing it correctly? Now, TurboTax and all those other programs do a great job of it, but you just never know, right? Like you
Just
don't
have
know.
it down. So I want to jump into what sort of sparked you and Busayo to start Muse Tax. Like, what are the gaps that you saw, the pain points, the stuff that you felt like, hey, people really hate this. So if we can do it for them and do it right, there's a massive opportunity here.
Yeah, so chance conversation. So at the time, I'm a tinkerer. I taught myself how to code a few years ago. So I was building this thing that allows you to check your tax returns. And I remember seeing, major tax company had this thing where you can go in and get your taxes checked from the prior year. That's a good idea, but you're still it's still susceptible to some of the same issues where if that new tax preparer doesn't know something, then they may miss it as well. I was like,
Yeah.
if you use AI and you feed it enough information, it will have a broader knowledge, right? Because every time
Yeah.
you go to a tax preparer, it's their anecdotal knowledge. They usually apply things they've done before, as opposed to AI, where it has a full breadth of knowledge. So there's a better base there. I said, okay, well, I can build that. So I started building it. And I was at Basayo's house one day and he was like, yeah, I'm working on some tax planning software. I was like, oh, I didn't know you were doing that. So I was like, well, mine is pre or what is it, anti, and then yours is posterior. It's just like, oh, so I'm before the fact, you're after the fact. Why don't we just combine?
Merge them.
Yeah, because I will need tax planning because when I find all the things you missed, I
Yeah.
need that person to plan to get it next year or this year or go back and get it from the prior year. I'm like, yeah, why don't we do that? Now, also a great thing about Basayo, again, he has a wealth of knowledge. He's written best-selling books on Amazon about tax planning, but he was also the first person to build an AI tax chatbot. Doesn't sound that impressive today, but this was 9 years ago, or 8 years.
Wow.
And I helped him with that, in many different ways. He built it the old fashioned way with NLP, natural language processing, and just good old machine learning. And this is 8 years ago. He had none of the transformers, which is what ChatGPT is a transformer to do generative AI. So he had to build that himself. I also did
Yeah.
that. And that sort of rolled into Muse, so the name of the chatbot was Ask My Uncle Sam, AMUS. So internally, we used to call it Amos. So I said, well, my Uncle Sam, I like that name. So why don't we roll that into this new company? We are experts in tax, so why not call it My Uncle Sam Experts? And that's how Muse was started.
I love it. I did not know that about the name. I absolutely love it. You touched upon something that I feel like most Americans deal with, right? I remember early on doing my taxes myself. I felt like, oh, it's pretty easy. My situation is simple. I should be able to do it myself. I was wrong. And when I finally brought in a pro, I missed a bunch of deductions. I was a student at the time getting my MBA. There were deductions I should have taken. I wasn't doing it right. And we literally had to file like 3 years back. And so I want to talk about that because I think that's a big part of people viewing taxes like a task, like I just need to get it done, versus like taxes as a strategy and a way to sort of like on preserve more of your money, which will help you build more wealth. And we're all about getting it right so that you hold on to more of your wealth and you can invest and you're not making Uncle Sam, Uncle Amos wealthier than they need to be.
Yeah, no, that's a major thing. So a lot of people have this, like they treat taxes like going to the dentist. I got to do it once a year. Well, dentist hopefully twice a year at a minimum. But
Yeah.
I have to do it. It's an obligation. I'm just going to get it over with, make it as painless as possible. And those who are wealthy realize, like, hey, wait a minute, this can be to my benefit, right? Like I tell people, two people can make $100,000, but one person can go home with 85,000. Another person can go home with 65,000. And the difference in that 20,000 is how good is your accountant, right? Your accountant may say, hey, if you invest here, or for example, here's a great example. You bought Tesla stock and you're up 30%. A good accountant will say, well, you've been owning this stock for 11 months. Don't sell it now because you're going to get hit with
Short term
short-term capital gain,
capital gains taxes. Yeah.
is higher than long-term capital gain taxes. And a good accountant will say, hey, how about we keep that for another month or so and we sell it then? Because especially if your income is below a certain rate, you actually don't have to pay taxes on it at all. And then if it is above that, then you pay a lot less in taxes. A good accountant will say that. And having a good relationship with your accountant where it's like, hey, I'm about to make a decision or a transaction that has some tax implications. Can you guide me on that? And they'll guide you the right way. A lot of times, and again, this is me going back to my CPA days, people will make a decision and come to me and at the end of the year, like, hey, yeah, so by the way, I stole that stock. I'm like, Why'd you do that? You should have told me before you did it.
Before
Or
you did that.
I bought this for my business. I'm like, there was a better way of doing that, and they're like, oh, fix it. I'm like, well, it's already done. There's nothing I can do now. You should have told me before, right? Again, but people don't think about their taxes. Someone who is wealthy and
You are so spot on about that, right? People are, and that's why we wanted to have this episode so people can sort of think of their taxes differently and the strategies. And that example is spot on. Like the difference between bringing home 85,000 versus 65,000 and not having that sort of wherewithal or knowledge or feeling like, to your point, like I just need to get my taxes done versus understanding the tax code. And the timing is perfect, right? Because taxes are political, folks. We have a whole effort happening right now in Congress about the tax code. And what I've observed is all the rich people are all hands on deck about how this new tax bill will be written. And most everyday folks only hear the soundbite tax code and don't even realize what their representatives are voting on. And it actually matters. And rich people are all over it because they're like, hey, we know what we want out of this bill.
they're all over it, and because it affects them, right? And they understand the effect of it. For example, one of the most hotly contested things is the SALT, or the state and local tax deduction, which right now is capped at 10,000. If
Yes.
you live in New York and you own a home, your property taxes are way more than $10,000.
Same in PA. I hate that thing.
Yep. And I own a place, and I remember when it switched, I was like, "Hey, why do my what do you call it? My deductions go down by so much?" And I was like, "Oh, wait, it's 2017. They capped the deduction."
Yes. They tank the deductions for
Yeah,
people in like high tax codes.
exactly.
We're still feeling it.
Yep. So it's one of those where they're like, "Oh, well, the offset is we increase the standard deduction, which is great, but if you're right now it's 15,000, you know, if you don't have more than $15,000 in deductions, then you'll have to take the standard." But some people are like, "Well, I pay $50,000 in property tax,
Absolutely.
deduct 10,000." Now, again, if you pay $50,000 in property tax deduction, you must have a massive home, right? And again, you're probably
Yeah.
well off. So they think about those sort of things. Other things that they're looking at is like the child tax credits, right? They're trying to increase that and the opportunity to get those child tax credits. They're limiting certain deductions. All those things, a lot of people are on top of those because, like, well, that affects me. That affects family. That affects my tax returns. Because right now, I think they're looking for a $30,000 limit on the state and local tax deductions, which affect property tax.
Yeah, we definitely need that. Like, I am right to your congressperson. When we took the SALT down, I remember like calling my accountant, being blindsided when that return came, or, what I owe like jumped massively. And they were like, oh, this is the impact of the new tax bill. And when you live in a county state that has high state and local taxes, 10,000 is nothing.
Yeah. That's because remember, that's just the state and local tax deductions. You also have to pay other state taxes, right? So all of your other state taxes plus that goes towards your $10,000 limit.
Exactly. Yeah.
So if your state taxes alone are over 10,000, you're basically getting no deduction for all the other state taxes. So now
Yeah.
if it passes and it's 30,000, we're saying, well, should it be 30,000 for a single person, or 10,000 for a single person and 30,000 for a family,
Family.
or maybe 15,000 for an
A
individual?
single. Yeah.
Married, filing jointly, you get 30. That matters, right? Because that's
Totally
an
matters.
additional $20,000 that you can deduct on your tax return.
It's huge.
That's money that comes back to you, right? Then
It's
there
huge.
people don't think about where, it's just like, okay, well, uh, for example, you own a business, right? And during COVID, the president declared all 50 states in U.S. jurisdiction as a disaster, uh, right? There are certain deductions and credits available to people who operate a business in a disaster area.
Master zone. Yeah.
People miss that. The amount of people who miss those things. A good accountant will tell you that.
Yeah. But so many people have what I'm going to call like a very transactional, once a year episodic relationship with their accountant. It's like, it's time to file. Here are all my documents. Just let me know if I'm going to get everything in by April 15th versus like, hey, I'm about to make this major decision. Can we chat quickly about potential tax pros and cons, right? And this is why we tell our Wealthmore folks, like, hit the message button, schedule the one-on-one in the app, because your wealth planners are pretty competent at taxes and we have tax specialists. So before you take action, call us, reach out, because it's thousands of dollars that could be impacted.
Yes, and not only that, but you should at least do it twice a year outside of filing, mid-year, at some point between April to July. Mid-year, hey, here's what's going on. Planning to get married, and I'll touch on being married in a second. And then in October, November, because it's like, hey,
Okay.
where do I stand? I have a month or two to fix it before
Fix
the
it.
year. So
Yeah.
what do I need to know? For example, if you have stock that's at a significant loss, right? Like if you remember last year,
Yep. Tax loss harvesting. Yep.
there's tax loss harvesting. You're like, hey, I expect the market to go back up, but why don't you have a lot of gains right now? Why don't you sell it, take that loss, and then buy it back after 30 days to avoid the
Yeah.
water rule? And then, you get some tax loss harvesting, right? So you want to talk to your tax
Yeah.
accountant or CPA or whoever your advisor is at least 2 times a year outside of the filing period. Now, going back to being married, weird, but one of the most common questions Bisai and I got when we were running our CPA practices, should I get married this year or next year? I thought that's really weird. You should be getting married for love. And well, no, because my spouse has debt. They make more or less than me, and we're not going to be coupling it. So if you're married as of December 31st of that year, it's as if you were married the whole year. So now you're thinking to yourself, well, I make X, my spouse makes 2X. My spouse may have a bunch of investments and all these other things. They have a really complicated tax return. And now I have a simple tax return, whereas I just have one job, I have no investments or anything. Do I want to take that hit this year? Do I want to couple those this year, or do I want to do that next year? Those are the sort of things that people kept asking us. And I was like, oh, like I'm not married. So I was like, oh, I get it now. Like you're coupling your taxes
Yeah.
with someone
You
else.
so are.
And now
That
it's
is
your
a
tax situation now.
that's a great point. And I would, as a woman, and everybody wants like the summer wedding. Maybe you do the ceremony in the spring, but sign the certificate
On January 1st, I
in
hate it.
January.
Right, that's a 2026 problem. That's a future me problem.
When you sign the certificate is when it counts, right?
Exactly. Right. You can do anything you want. When you sign that certificate, just make sure you know, do you want it to hit this year or
Yeah.
next year? Because you're going to be filing jointly. Now you can file separately, married filing separately, but you also have to understand you miss out on a lot of deductions
Yeah.
if you're married filing separately. There's certain deductions that are one, not available to you if you married filing separately, or two, they are limited if you're married.
Yeah. Wow. So, Colin, I want to get a little into, we talked about this, folks, like pay attention to the new tax codes, influence your local representatives so that these tax cuts are not just benefiting the wealthiest people, that it benefits us everyday Americans, and have those two conversations a year with your tax pro. And one of the things that I definitely want to talk about in those two conversations are things like the tax benefit wealth opportunities, right? Like the Roth IRA. We always get a lot of questions about that. And frankly, most people want to do it, but don't fully understand how it needs to be reported on their taxes.
Right. Yeah. So with the Roth IRA, again, just to go over it from a high level, there's traditional IRA or 401ks where traditional just means you pay taxes later on. Roth IRA, you pay taxes up front. Now, it's always tough to tell someone which they should go with, Roth versus traditional.
Additional.
It really depends on what you project your tax situation to be later on in life.
Yeah.
But what people need to understand also is if you do like an IRA, you can make additional contributions up until April 15th, I believe.
Yeah.
I apologize if I get that date wrong, but I believe
That's right.
right up until April 15th, you can make additional contributions. So if you do have some money, you're like, you know what, I want to stock this away for later on, which you probably should do. You should try your best to maximize all those contributions because you get the tax benefit and you also get the compounding of it over time. A lot of people are like, well, do I want to take the hit now? Me personally, and again, this is my personal decision. not projecting on anyone. I like to go with Roth because I'm like, look, just take the taxes now. I know that what's in there
Yeah.
for me, and we can deal with whatever happens in the future. I can't control that. I can't control if they're going to change the laws 30 years from now, but I know I already pay taxes on it. As opposed to you're thinking, oh, wow, I have $500,000 in there. You take it out. And this happened to one of my old clients a couple months ago. She wanted to pay for a retirement party and took some money out, forgetting that she didn't pay taxes on that money yet. So she asked for 10,000. She ended up getting about 57 or $5,800. And she's like, "What happened to my money?" I'm like, "You have to pay taxes on that."
Uncle Sam. Uncle Sam.
Uncle Sam,
Yeah.
give me
This
mine.
is a big one that I feel like, wealthies really have a conversation with our wealth advisors about this in terms of, do you want to pay the taxes up front? Do you want to do a Roth or do a traditional where that tax bill is later? And I know some people say, well, in retirement, I expect, my tax bracket to be lower, et cetera. But, that investment has grown significantly,
Yep.
right?
And also, well, when you do retire, ideally, you want to set yourself up with so many investments and so many things that you're just collecting and you're just making money hand over fist when you're, what is it, 70, right? So you would love for that. Now, don't this, and this again, this is my personal opinion. Don't say, oh, well, I'm just going to be living on Social Security when I'm 73 and my income's going to be lower. Personally, I'm like, well, I want to put so many systems in place. I want to have real estate. I want to have
Yes.
and this, and have investments and all that stuff where my income is actually doing pretty well
Meaningful. Yeah.
at 73 and I don't have to go back to work.
Yeah. None of us should aspire to be living off of Social Security only and broke in retirement. That's not what we're here to do. We're here to set you guys up for success. And you should expect that, in retirement, you're going to have a high income and think about those taxes strategically.
Yes. And I always say, to me, I know it's a really weird way to look at taxes. Paying taxes is a privilege, right? I remember one time I was at this event and this guy said, one of my goals is to pay $1 million in taxes. I was like, that's,
I'm not with you yet.
he's like, I want to pay $1 million in taxes. He says, well, people are like, well, that's a lot of money. He's like, that means I made a lot of money.
Yes.
If I can pay $1 million in taxes, I must have probably made about $5 to $10 million, depending on
Yeah.
how, right? As opposed to, well, I don't want to pay a lot of money in taxes. I just want to pay 20,000 or 10,000 in taxes. Unless you have a great accountant and you have a lot of businesses and you can use those deductions to just about nullify. And you've seen some of these big corporations where they pay no taxes. But again, if you're making that much money, you're going to pay a lot of taxes. Like I used to tell some of my clients, you made a lot of money. You got to pay the taxes on it, right? Like I know it's a lot of money that you're paying $150,000 in taxes, but you also made $10 million this year.
Yeah. I'm going to have to sleep on that one, Colin. I'm going to mull it over the weekend and see how I feel on Monday about this one because I'm definitely not quite there yet. And this is a perfect segue, but I'm also not at the other end of the spectrum. And this is somewhere we want to like debunk folks on, which is kind of like expecting a return and wanting a return, right? Because that generally means that you are paying too much over the course of the year. And this is where I want to talk about your exciting new product, Check Boost. I saw it, I was like, oh, we have to talk because so many people, in my opinion, should be thinking about a product, using a product like Check Boost. But I'll let you explain to our listeners what Check Boost is.
Sure. And before I get into checkbooks, so the whole idea behind Muse is we find tax deductions and credits for tax payers, and we use an AI model that can distill the U.S. tax code and provide financial insights. So with checkbooks, what we realized is a lot of people usually depend on a tax refund and think that it's free money. It is not free money. It's actually
Nope.
your money. I don't want to get into too much of the math and the specifics behind it, but what you're really doing is when you file your W-4, when you start a job or you have any type of life event, you're telling the IRS how much to withhold on your taxes. Generally, they make you over withhold, right, to ensure that your taxes, which is not a bad idea. But when you over withhold, the average person right now, if the number changes every week, last time I checked, it was $3,300 on average. That's people getting tax refunds.
Wait, say that again, please, loud and clear.
$100 is the average tax refund as of the last time I looked at it, which is about a week or two ago.
Colin, did you say $3,300?
$300 is the average. Now, here's the other side of that. On average, every year, over $360 billion is overpaid to the IRS. 160 billion with a B is overpaid to the IRS, which they have to.
My dollars better not be in that pool.
Most people are, right? Because the majority of individuals in this country get a tax refund. What's happening is they're saying, okay, well, withhold, and then I'll get it back in April. Not to get into too much of the specifics, but the money you get back in April is actually worth less than had you gotten it now.
Exactly. Because you could have been investing that money.
Not only that, but there's inflation, which I think last time was around 2 point something percent, which is the lowest since 2021. Compared to like 2022, when inflation was 4 or 5%, your money, a dollar today, is worth 4 to 5% less, or
Yes.
worth 4 to 5% less. Right now, it's worth 2.7% less. With tariffs going on, potential, recessions. I'm not getting all that, but every dollar you get, it's now worth 2.7 cents less in a year. So you want that money now. That's one
Yes.
side of it. Then you also want to
People, I want you guys to listen. You want your money now, not next April.
Because you can put that money, conversely, you can put that money in a high yield savings account, because if you optimize your your paycheck, you can take that money that you are giving away to the government, interest free, by the way.
Yeah.
All right. And then you put that in a high yield savings account, getting what, I don't know, the prevailing rates right now.
4-ish%. Yep.
Now that dollar is now worth 4.4% more next. All right.
Yeah.
So that's a 6% swing. 6 to 7% swing. Instead of losing 2.7 cents on it, now you're 4.4 cents on it. So that's about a 6 to 7 cent swing, right? So 6 to 7 cent and percent, again, using a dollar, right? So you want that, and also you want
got it
of your money throughout the year.
And I want to put that in terms, because before this episode, we were talking internally about people overpaying taxes, essentially giving the government a 0% loan on their money for 12 months, 12 to 15 months, because refunds are then like, April. And the same folks having credit card debt and paying 29, 27% on consumer debt, but then issuing the government a tax-free loan on their money. I want that to sit with you guys, right? Your credit card is not allowing you to have $5,000 in a balance at 0%. They expect to be paid, but you're allowing the government to hold your money for 15 months essentially at 0% interest. And then on April 15th, when you get your refund, you're actually excited. I don't want y'all to be excited. Please don't.
It's not the right way to think about it. Now, I'll talk about the psychology of it in a second, but one thing you mentioned, the Wall Street Journal last year, and I think this year Yahoo Finance wrote an article saying that the majority of people took their tax refunds and used it to pay down debt. And I said, that to me is such a backwards way of thinking. I'm not judging them for it, but it's a backwards way of thinking, because keep in mind what I said. You're taking money that's worth less because of inflation, right, to pay back money that you're paying 25% interest on for the last year. Meanwhile, you could have been taking that money right away and paying down that debt. So now you're paying down the principal. So there's less interest on it a year.
Yeah.
Right. And people are like, well, they're conditioned to getting that lump sum of money because they think it's free money.
Yeah.
Some people are like, it's a forced savings for them, because they're like, if I get that extra $100 or $200, I'm going to spend it. Now, what we do at Check Boost is,
But it's a D savings.
it is, but again,
Yeah.
to do, and that because
Yeah.
they've been working for 30, 40 years, and every year they get $3,000 back, and they're used to getting it. But what we do at Check Boost is, not only do we optimize your paycheck to ensure that you're paying the right amount of taxes, right? But also when you get that boost in your paycheck, because we say, okay, well, it looks like you're going to get a $4,000 or $5,000 refund. Let's do what we call early refund access. The only way to get access to your refund now is using Check Boost, and allow optimize your or tweak your withholdings so that you can increase your paycheck, right, by adjusting the amount of taxes that you were overpaying in the past. We ensure that the individual pays the right amount of taxes. But that increase in the paycheck, we tell them you want to do one of three things: pay down debt, invest, or save. Pay down debt. First thing, you want to pay down that debt. If you have money coming out, especially if you're paying 20 to 25% interest on it, or 29% for some people, you want to pay that down now. Then you want to invest it, right? Because if you're investing it, then it's going to grow over time.
Yeah.
And just save it and then put it in a high yield savings account.
Colin, how can our listeners get access to Check Boost? Because I'm like, I want all of them on Check Boost. I want them taking, if there's $3,000 out there, investing it, building wealth versus giving the government a 15-month tax-free loan.
I will send you a link that you can share with your
Awesome.
and all you call them wealthies. With all the wealthies, I would love to have a chat with them and love to get them on the platform.
I love it because this is the stuff that helps people build real wealth. It creates knowledge, particularly if you have consumer debt, student loan debt, and you're paying interest on that and you're sort of thinking of that return as like a big bump. And I know you sort of touched a little about this of the psychology of it. We internally think people are afraid of getting a tax bill. And hence they're like, the fear of owing is so much greater that they are like, that's a trade off they're willing to make. And I want to unpack that a little because what I love about how Check Boost works is they can play with it, right?
Yeah. So again, the fear of something is always more impactful than the joy of getting something else, right? Well, usually it's easier to tell someone, hey, you need to take this medicine because you're sick versus how about you not eat that because you're going to get sick, right? So tax bills, again, why I always say no one wants to get a tax bill, but look at it as, well, I had the full use of my money for the year. Now, again, make sure you pay your correct amount of taxes. Don't run up a tax bill. Make sure you accurately withhold and pay your estimated taxes. But if you happen to owe $300, $400, think of it as, well, I had full access to my money all year, and now I pay back the government, as opposed to, well, I'm getting $3,300. I gave them $3,300 to use all year, and I struggled all year because 78% of individuals in this country live paycheck to paycheck.
Yeah.
I was struggling to make ends meet while I was giving away money, interest free, by the way.
Yeah.
And now I get it back at the end of the year. And then I go pay down my debt. The way I look at it is, yes, again, it's very scary to get a tax notice and say, hey, you owe money at the end of the year, especially for the last 10 years you've been getting a refund. But look at, well, I had the full use of my money all year. Now, ideally, you would want to have a small refund, right? Hey, I'm getting a refund of $50, $100.
Yeah.
I paid my obligations and a little bit more, right? But I had the full use of my money all year. Some people are like, man, I got an $8,000 refund. I'm like, you had $8,000 you could have invested throughout the year. Now, here's a compounding effect on that. If every year you get an $8,000 refund, right? Because maybe you have three children, and one is in college, and you're getting all these deductions and credits. Imagine for the next 5 years, that's $8,000 that you're giving away and not investing. Just like I always tell you, start investing in your 401k and your IRAs early because it compounds. Had you been investing, that's $32,000 over 4 years that you could have invested,
Yeah.
at least 4 point something percent or whatever it invested, but you're getting nothing on it. In fact, it's worth less than $32,000 now because when you got it back, inflation adjusted, it's worth less than $32,000 now.
Now, this is not tax advice, guys, but me personally welcomes the tax bill because that means I was able to invest my money, use it. And when the government's like, I actually budget for the tax bill because I prefer to control my dollars, have them in the market working for me. I've said this to you guys before, lazy money does not serve you. I want to put my money to work. And then I will pay Uncle Sam accordingly, but I do not believe in giving Uncle Sam a tax-free loan.
One thing you said, again, nothing I say here is tax advice. This is, I always preface a lot of things I say as this is my opinion. Again, personally, I, I think it's a good idea to just get a little bit of a refund to make sure that you pay just enough. Because again, they hit you with penalties and interest and all that stuff if you
Yeah.
don't pay. And then what tends to happen is people, the reason they freak out is when they have a tax bill, like, well, I already spent all that money. And one thing you said was you budget for it. Most people don't.
Budget for it. Yeah.
So if you get a $700 bill, like, wait, I'm already living paycheck to paycheck because I've been blowing the money. I don't have $100 to pay. I'm like, well, but you made it though. You made the money. They're not asking you for it because you didn't make it. You made it, right? But people don't budget for that. That's why I say it's a good idea to. And again, there's nothing wrong with getting making sure you pay the correct amount of
Yeah.
taxes, a little refund. But when
Yeah.
people are getting five and six and eight and $10,000 in refunds, I'm saying that's financially inefficient.
Yeah. No, totally agree with you. Colin, before we sort of wrap up, I do want to talk a little about folks that have like, their income varies, right? Like, let's say if you have like a side hustle, if you're a gig employee and it's a little harder to sort of like, or, we have plenty of people who have big bonuses, quarterly bonuses that they can't really anticipate or don't know exactly what that's going to look like, and that sort of like makes their tax situation a little harder to like chart out perfectly.
There's a check boost for that. So with check boost, we take into account all types of income. We ask you if you're getting a bonus. Did you have side income? Do you have interest income? A lot of people always forget that. Yeah, I have $10,000 at Chase, and Chase paid me $200 or $300 in interest, and you get that at the end of the year, and you completely forgot about that 1099 INT.
Yeah.
We ask them about that. What do you anticipate to get from Chase? Great thing you can also do on the check boost and through Muse, you can upload your most recent tax return, and we can actually go through and use OCR, optical character recognition technology, track all the data from it, and basically have a tax profile for you. So we can say, last year you paid $300, well, you got $300 in interest income. You may be getting that this year. So you may want to say, okay, I'm getting $300 to $400 and factor that in. Last year you got a $50,000 bonus. Chances that you're probably going to get somewhere in that neighborhood, but let's account for that. So you can account for that. You can
Yeah.
account for side income and all those sort of things.
Wow. I mean, I see so many benefits of using check boosts as a consumer. I also feel like every tax accountant should have access to it so that they can look at their client's tax situation and have that twice a year conversation as well, but with the benefit of like the tool as well.
Yep, exactly. And we have like the whole planning aspect of it where, all right, well, you missed a deduction last year. Let's show you how to get that deduction this year, especially if you have a business or you have children. We ensure that you're getting as many deductions and credits as possible while also making sure that you stay compliant.
Wealthies, I always like to say, this is the area in our life that, we've been sort of told that you have to be the patient and the doctor when it comes to your money. I don't want you guys doing that. This is why we make our wealth advisors available. This is why we bring folks like Colin on so you guys can see sort of like the benefit of reaching out to the pros, leveraging these strategies so that you do better when we try to like, fake it ourselves and try to figure it out, you know, we shouldn't have to, right? Like Colin, as he mentioned early on, like he's been doing this since he was 15. By no means can I become like a tax pro overnight, and I don't want to and would not expect that I could ever do it as well as these pros are doing it. So, Colin, before we sort of let you go, I want to do like a quick fire set of questions with you. All right, here we go. What's one financial tip you live by?
Pay your credit card bills in full on time every month.
I grew up in the credit card space. I have to like ditto that 100%. Treat those credit cards like a debit card. If you love those rewards, get those rewards, but do not pay interest. And if you have a balance on a card, stop using it. Don't continue using it because you start paying interest on day one of every subsequent transaction. Yes, Colin, I love that one.
And to that point, I know it's rapid fire, but if you bought something on sale, right, it was normally $300 and you paid $250 for it. By the time you finish paying it off with the interest that it's accumulating, it's probably going to cost you more than $300. And you would
Definitely.
more than $300. But people, it's not salient to them, so they don't think about that.
Great example. Next one. Who is someone that shapes your views on business or finance?
I would say, I hate to give like the cliche answers, but I mean, I look at other entrepreneurs, Musk, Buffett, um, but just others like even like Mark Cuban and just the way they look at finances and taxes, because these guys, wealthy people, are so knowledgeable about taxes.
Yes.
because they talk to their accountants like just like they talk to their doctor. Like, hey, I need to know everything because I need to make sure I'm making the right decision. So I would say those are a handful. Shaq as well. He's done a lot with investments and setting up a team. An accountant or CPA should be on
Yeah.
your advisors.
Exactly. I mean, rich people have what's called a family office for a reason because they need pros in each swim lane so that they can like keep their money, more of it, and not sort of like foolishly give away massive amounts of money just because, hey, I wasn't aware this was out there.
Exactly.
Ignorance is not bliss when it comes to your money.
It's very expensive.
Yeah. Here's a good one. What's a myth about taxes that you'd love to bust once and for all?
We already spoke about it, but a refund is not necessarily a good thing because
100% agree.
you can use that money for something better throughout the year.
100%. That is like every planner at Wealthmore would echo that wholeheartedly.
Yeah. To be more specific, a large refund. Some refund is okay. Again, make sure you pay the accurate amount of taxes. But if you're getting a massive refund, that means that you're giving away money and getting back your own money that you gave away at the end of the year.
I switched this last one up. So, what does a tax accountant do for?
I like to say I'm not your dad's accountant. I like to travel. I I like to do fun things.
Awesome. Colin, I can't thank you enough for joining us. We have wanted to like book this. We finally got it on the calendars and it did not disappoint wealthies. Hope you guys are walking away with like great insights and tidbits. You know, you can schedule one-on-one with a Wealthmore planner anytime, right from the website or download the app. But taxes can be used to your advantage or your detriment. We want you using it to your advantage. Stay tuned until next time. Thanks for joining us, Colin. Thanks for being our first guest ever on our 16th episode. Wealthies, until next time, all the wealth.
Take care, everyone.